According to a new report published by the Fraser Institute, Canadians at all levels of income pay more tax than residents in most other OECD countries around the world. The study, titled Canada's Rising Personal Tax Rates and Falling Tax Competitiveness, highlights how personal income tax rate increases at both the federal and provincial levels have made Canada less competitive compared with other countries in the OECD. In 2022, Canada had the fifth highest combined top tax rate out of 38 countries. It was uncompetitive compared to most OECD countries, including the United States, the United Kingdom, and other English-speaking countries such as Australia. According to the report, Canadian provinces were in the top 10 spots for highest tax rates in the OECD. These include Newfoundland and Labrador at 54.8%, Nova Scotia at 54%, Ontario at 53.53%, British Columbia at 53.5%, and Quebec at 53.31%. According to the report, Prince Edward Island landed in the top 15 with 51.37%, while Manitoba 51.40%, Alberta 48%, and Saskatchewan 47.50% were in the middle range. Authors Jake Fuss and Grady Monroe said high-income tax rates hinder Canada's ability to attract workers and discourage people from achieving higher incomes. On April 9th release, Mr. Fuss said, "Our high-income tax rates can deter professionals, entrepreneurs and business owners from working and investing in Canada, which is bad for the Canadian economy and therefore Canadians." Mr. Monroe said in the statement, "If policymakers want to attract and retain skilled workers and job creators and encourage entrepreneurs, we must lower personal income tax rates and avoid higher rates at all costs." The authors wrote, "Canada's marginal tax rates are also uncompetitive at incomes of CAD 75,000 and CAD 50,000. The survey found that 55% of Canadians think the government spends too much money, while 27% said government spending was at an appropriate level. 8% of respondents said spending was too low. According to the report, tax rate increases do not generate the expected government revenue. A primary reason that various governments have increased their top personal income tax rates since 2009 is to bring in more government revenue, either to reduce their budget deficit, to partly pay for a reduction in other tax rates, or to finance new spending. However, governments often overestimate how much revenue they will reap from increasing the tax rate because they fail to take into account the various ways that taxpayers respond to such increases. As a result, government finances often do not gain as much new revenue as initially expected. The level of revenue collected from a specific tax depends not just on the tax rate, but on the base, or the total income that is subject to the tax. Multiplying the tax rate by the tax base results in the amount of revenue that a government will receive from a particular tax. When governments increase tax rates, taxpayers often respond by changing their behavior in ways that shrink the tax base. This often results in governments collecting significantly less revenue than they expect as a result of new tax rate increases, especially if they assume that these tax rate increases will induce no behavioral responses that will shrink the tax base. There are a number of ways that taxpayers can respond to a tax increase that would reduce the tax base. First, a higher tax rate can encourage some taxpayers to work less and report less taxable income. Second, higher income taxes could lead taxpayers to negotiate with employers to substitute away from taxable income to more tax-favorable forms of compensation such as fringe benefits. Third, a taxpayer can take advantage of lower small business tax rates by channeling income through a small business. Fourth, a taxpayer could make use of other legal means to avoid taxes via various rules in Canada's complex tax code. Finally, some taxpayers can shift income to other jurisdictions with lower tax rates. Upper income earners tend to be more responsive to tax increases. In addition to income tax, the government is also introducing a second CPP tax called CPP2, which applies to those earning between $68,500 and $73,200. These findings highlight the complexities of tax policy and the varying impact on different household types in Canada. At the conclusion, they said, since 2009, The federal government and most provincial governments have imposed new, higher top personal income tax rates. These increases have led to considerable increases in the marginal tax rates that upper-income earners across Canada pay. How have higher income tax rates in Canada since 2009 impacted the country's economy and its ability to attract and retain highly skilled workers? Feel free to discuss. For getting regular videos, please subscribe my channel.